Have you ever wondered why two people with similar incomes can get completely different loan approvals? The answer often comes down to one thing: your credit score. Today we're going to break down how credit scores really work, what hurts them, and what you can do to improve yours. Let's get started. Your credit score is a number that lenders use to estimate how likely you are to repay borrowed money. In most cases, credit scores range from 300 to 850. Generally speaking, 800 and above is considered excellent. 740 to 799 is very good. 670 to 739 is good. 580 to 669 is fair. Below 580 is considered poor. But here's what many people don't realize. A credit score isn't based on how much money you make. You could earn $100,000 a year and still have a low credit score. Meanwhile, someone making much less could have excellent credit. That's because credit scores focus on how you manage debt, not how much you earn. One of the biggest factors affecting your score is payment history. If you pay your bills on time, that's a good sign to lenders. Late payments, collections, charge-offs, and repossessions can negatively impact your credit profile. Another major factor is credit utilization. This refers to how much of your available credit you're using. For example, if you have a credit card with a $1,000 limit and you're carrying a $900 balance, your utilization is 90%. High utilization can lower your score. Many experts recommend keeping utilization below 30%, and even lower if possible. Next is the length of your credit history. Older accounts can help your score because they show a longer track record of managing credit. That's why closing old accounts isn't always the best move. Your credit mix also plays a role. Lenders like to see that you can responsibly manage different types of credit, such as credit cards, auto loans, and mortgages. Finally, every time you apply for new credit, a hard inquiry may appear on your report. A few inquiries aren't usually a big deal, but many applications in a short period can raise concerns for lenders. Now let's talk about some common credit myths. Myth number 1. Checking your own credit score hurts your score. False. Checking your own credit is usually considered a soft inquiry and does not lower your score. Myth number 2. Paying off a collection automatically removes it from your credit report. Not always. A paid collection may still appear on your report depending on the reporting policies and credit bureau guidelines. Myth number 3. You need to carry a balance on your credit cards to build credit. Also false. You can build excellent credit by paying your balance in full and on time. So what can you do if your credit score needs improvement? First, make every payment on time. Second, reduce high credit card balances. Third, avoid opening unnecessary new accounts. Fourth, regularly review your credit reports for errors. And finally, be patient. Credit improvement often takes time and consistency. There are no magic shortcuts. A strong credit score can help you qualify for better interest rates, lower monthly payments, and more financial opportunities. The good news is that no matter where your score is today, positive habits can make a difference over time. If you found this video helpful, be sure to like, subscribe, and turn on notifications for more tips on credit, personal finance, and smart money decisions. Thanks for watching, and I'll see you in the next video.